Quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Markets do not move purely on data. They move on interpretation. They move on belief. They move on narrative. And this is where most traders begin to lose clarity, because they assume that price reflects objective truth. It does not. Price reflects what participants believe to be true at a given moment, under a specific set of conditions, influenced by positioning, incentives, and emotion. A narrative in markets is simply a story that explains why something is happening. It provides coherence, it reduces uncertainty, it gives participants a framework to justify decisions. But the critical mistake traders make is assuming that narratives are stable, or worse, that they are accurate. Narratives are fluid, they evolve, they are often constructed after the fact. Price moves first, and the narrative follows. This is not a theory, it is observable behavior. You will repeatedly see markets move sharply, and only afterwards does the media or even institutional commentary construct a story that explains the move. This matters because if you are trading based on narrative alone, you are almost always reacting, not anticipating. You are consuming the explanation of what has already happened, rather than positioning for what is likely to happen next. Professional traders understand that narrative is not a signal. It is context. It is something to be interpreted alongside positioning, liquidity, and macro conditions. It is not something to be blindly followed. More importantly, narratives serve a function. They align participants. They create consensus. And consensus is where opportunity begins to fade. When a narrative becomes widely accepted, it is already embedded in price. At that point, the risk shifts. The market no longer rewards agreement. It begins to reward divergence. So the first principle you must internalize is this: markets do not move because narratives are true. Markets move because participants act on those narratives. That distinction is critical, because once you understand that, you stop asking whether a narrative is correct, and you start asking who believes it, how strongly they believe it, and how positioned they are around it. To operate effectively, you need to understand how narratives form. They do not emerge randomly. They tend to originate from a combination of macro conditions, data releases, and initial price reactions. A catalyst occurs, price responds, and then participants begin to interpret and explain that movement. At first, the narrative is uncertain. There are multiple interpretations. Market participants disagree. Volatility is often elevated because there is no clear consensus. This is where early positioning occurs. Institutional traders begin to form views, not because they are certain, but because they see asymmetry in how the market might interpret the situation. As more data points align, or as price continues to move in a consistent direction, the narrative begins to solidify. More participants adopt the same explanation, media coverage reinforces it, analysts publish reports supporting it, the narrative gains credibility. At this stage, the market begins to trend more cleanly. Participation increases, liquidity improves, the move becomes more orderly. This is often where retail traders begin to engage, because the story now feels clear and convincing. But this is also where risk begins to build, because as more participants adopt the same narrative, positioning becomes crowded, the trade becomes one-sided, and when positioning becomes extreme, the market becomes fragile. Eventually, something shifts. It may be a data point that contradicts the narrative. It may be a change in liquidity conditions. It may simply be exhaustion of participants willing to enter at current levels. When that happens, the narrative begins to weaken. At first, the shift is subtle. Price stops trending. It consolidates. then it begins to move against the prevailing narrative. At this point, participants are forced to reassess. Some exit positions, others double down, volatility increases again. This is the transition phase where the old narrative is being challenged, but a new one has not yet fully formed. This is where some of the most significant trading opportunities exist, because the market is repricing uncertainty. Understanding this life cycle allows you to position yourself not at the point of maximum consensus, but at the point of transition, where risk-reward is most favorable. One of the most dangerous behaviors in trading is narrative attachment. This is where a trader becomes emotionally or intellectually committed to a particular story about the market. They stop evaluating new information objectively. They begin to filter data in a way that supports their existing view. This is not a minor issue, it is a structural weakness. Because once you are attached to a narrative, you lose flexibility, you become slower to adapt, you hold losing positions longer, you exit winning positions prematurely if they conflict with your belief. Narrative attachment is closely linked to confirmation bias. You seek out information that validates your view. You ignore information that contradicts it. Over time, this creates a distorted perception of reality. Professional traders operate differently. They treat narratives as temporary frameworks, not permanent truths. They are willing to adopt a narrative if it aligns with data and price action, but they are equally willing to abandon it the moment conditions change. This requires a specific mindset. You must be comfortable holding views loosely. You must be willing to be wrong. You must prioritize adaptation over consistency of opinion. There is a critical distinction here. Consistency in process is essential. Consistency in belief is not. Markets change. Narratives evolve. If your thinking does not evolve with them, you become misaligned. So the question you should constantly be asking is not, is my narrative correct? The question is the market still behaving in a way that supports this narrative? If the answer is no, then your job is not to defend your view. Your job is to reassess. Another key concept is the difference between narrative and positioning. These are related, but they are not the same. Narrative is what participants believe. Positioning is what they have done as a result of that belief. The distinction matters because markets move based on positioning, not belief alone. A narrative can be widely accepted, but if participants are already fully positioned, there may be no incremental buying or selling pressure left to drive price further in that direction. This is why you often see markets reverse despite strong narratives. The story has not necessarily changed, but the positioning has reached an extreme. At that point, even a small shift in sentiment can trigger a disproportionate move, because participants are forced to unwind positions. Understanding positioning allows you to identify when a narrative is likely to continue and when it is vulnerable to reversal. If a narrative is gaining traction and positioning is still building, the trend is more likely to persist. If a narrative is fully established and positioning is crowded, the risk of reversal increases. This is where tools like sentiment indicators, flow data, and positioning reports become valuable. They provide insight into how participants are aligned, not just what they believe, but even without explicit data, you can infer positioning through price behavior. Extended trends with low volatility often indicate stable positioning. Sharp reversals and increased volatility often indicate forced positioning changes. Your role as a trader is to interpret this relationship between narrative and positioning. Not to follow the story, but to understand how it is influencing behavior and where that behavior may be vulnerable. Markets are not driven by fundamentals alone. They are driven by the interaction between fundamentals and perception. This is where the concept of reflexivity becomes important. Reflexivity describes a feedback loop where market perceptions influence fundamentals, and fundamentals in turn influence perceptions. It is not a one-way relationship. It is dynamic and self-reinforcing. For example, a positive narrative around economic growth can lead to rising asset prices. Rising asset prices improve financial conditions. Improved financial conditions support economic activity. This reinforces the original narrative. But the reverse is also true. A negative narrative can lead to falling prices, tighter financial conditions, and weakening fundamentals, which then reinforce the negative narrative. This creates cycles, and these cycles are often driven more by perception than by underlying data, at least in the short to medium term. As a trader, you need to recognize when markets are operating within a reflexive loop, because in these environments, price can move further and faster than fundamentals alone would justify. At the same time, reflexive processes are inherently unstable. They rely on continued reinforcement. If that reinforcement weakens, the process can reverse quickly. This is why you often see sharp turning points in markets that appear disconnected from incremental changes in data. The shift is not in the data itself, but in how the market is interpreting and responding to that data. Understanding reflexivity allows you to anticipate these shifts rather than being surprised by them. A critical skill in trading is distinguishing between leading and lagging narratives. Not all narratives are equally valuable. Some provide early insight into potential market moves. Others simply explain what has already occurred. Leading narratives tend to emerge when there is uncertainty. They are not widely accepted. They are often debated. They may feel uncomfortable to adopt because they lack consensus. Lagging narratives, on the other hand, are clear, widely accepted, and heavily reinforced. They feel convincing. They are easy to understand, but they offer little edge because they are already priced in. Your objective is not to find the most convincing narrative. It is to identify narratives that are in the process of forming before they become consensus. This requires you to pay attention to shifts in behavior, not just shifts in explanation. Are participants reacting differently to data? Is price responding in a way that deviates from the established narrative? Are there inconsistencies between narrative and market action? These are the signals that a narrative may be evolving. At the same time, you must be cautious. Not every deviation leads to a new narrative. Markets can exhibit noise and false signals. This is why narrative analysis must always be combined with risk management and probabilistic thinking. You are not trying to predict the future with certainty. You are trying to identify scenarios where the potential reward outweighs the risk based on how narratives and positioning are evolving. Media plays a significant role in shaping and reinforcing market narratives, but it is important to understand the limitations of this influence. Media coverage is reactive. It reports on events and price movements after they occur. It seeks to provide explanations that are accessible and engaging, but in doing so, it often simplifies complex dynamics into clear, linear stories. This simplification can be misleading. Markets are not driven by single causes. They are influenced by multiple interacting factors. Reducing this complexity into a single narrative can create a false sense of understanding. As a trader, you must treat media narratives with caution. They can provide useful context, but they should not be your primary source of insight. More importantly, media narratives can amplify consensus. When a particular story is widely covered, it increases awareness and participation. This can accelerate trends, but it can also lead to overcrowding. You should be particularly cautious when a narrative becomes dominant in media coverage. At that point, it is likely that the majority of participants are already aligned with it. This does not mean the move is over, but it does mean that the asymmetry has shifted. The potential for further gains may be limited, while the risk of reversal has increased. Your edge comes from thinking independently, not ignoring narratives, but analyzing them critically and understanding where they fit within the broader market structure. There is a common misconception that successful traders need to have strong opinions about the market. In reality, the opposite is often true. The best traders are not defined by the strength of their opinions, but by the flexibility of their thinking. Strong opinions can be useful if they are grounded in robust analysis and managed with disciplined risk, but they become dangerous when they lead to rigidity. Markets do not reward conviction alone, they reward correct positioning relative to changing conditions, and conditions change constantly. This is why professional traders often appear inconsistent in their views. They may be bullish one week and bearish the next. This is not a lack of discipline, it is a reflection of adaptation. The key is to separate conviction from attachment. You can have a high conviction view, but you must also have a clear exit plan if the market invalidates that view. This is where process becomes critical. Your decisions should be based on a structured framework that incorporates narrative, data, positioning, and price behavior, not on a single story that you believe to be true. Over time, this approach allows you to navigate changing narratives without being anchored to any one of them. One of the most valuable exercises you can do as a trader is to regularly deconstruct prevailing market narratives. Take the dominant story and ask a series of questions. What assumptions does this narrative rely on? Which of those assumptions are supported by data? Which are speculative? How is the market positioned around this narrative? What would need to change for this narrative to be invalidated? This process forces you to engage with the narrative at a deeper level. It moves you from passive consumption to active analysis. It also helps you identify asymmetry. If a narrative relies on fragile assumptions, it may be vulnerable. If positioning is extreme, the risk of reversal may be high. If price behavior begins to diverge from the narrative, it may indicate that the market is reassessing. This does not mean you should always take the opposite side of consensus. That is a common mistake. Being contrarian for the sake of it is not a strategy. It is just another form of bias. The objective is to identify when the balance of risk and reward has shifted. Sometimes that will align with the prevailing narrative, sometimes it will not. What matters is that your decisions are based on a clear understanding of how narratives, positioning, and price interact. Ultimately, narratives are an unavoidable part of trading. They shape how markets are understood, they influence behavior, they create opportunities and risks, but they are not the foundation of your edge. Your edge comes from how you interpret and respond to them. You must learn to operate at a level above the narrative, to see it as one layer of information, not the definitive truth, to understand that it reflects collective belief, not objective reality. This requires discipline. It requires constant reassessment. It requires a willingness to change your mind. If you can develop this skill, you gain a significant advantage, because you are no longer constrained by the need to be right about a story. You are focused on positioning yourself effectively within a dynamic system. Markets will always tell stories. Your job is not to believe them. Your job is to understand how they influence behavior and to position yourself accordingly. That is the difference between trading narratives and understanding markets. To take this further, you need to understand how narrative intensity influences market behavior. Not all narratives carry the same weight. Some are weak, fragmented, and short-lived. Others become dominant forces that shape entire market regimes. Narrative intensity is driven by three factors: First, the perceived importance of the underlying theme. Second, the level of agreement among participants. Third, the degree of positioning built around that narrative. When all three align, you get powerful trends. For example, when inflation becomes the dominant macro theme and central bank policy is clearly tied to that theme and participants are heavily positioned around it, the narrative becomes self-reinforcing. Every data release is interpreted through that lens. Every price movement is explained by that narrative. In these environments, markets can become highly directional, pullbacks are shallow, momentum persists, and traders who align with the narrative early benefit from sustained moves. But there is a trade-off. The stronger the narrative, the greater the risk of instability once it begins to weaken. Because when a dominant narrative breaks, the unwind is rarely gradual. It is often sharp and disorderly. This is because strong narratives concentrate positioning, and concentrated positioning creates vulnerability. When participants begin to exit, there are few natural buyers or sellers to absorb the flow. So while strong narratives can provide opportunity, they also require careful risk management. You cannot assume that a trend will continue indefinitely. You must be aware of how crowded the trade has become and how sensitive it is to change. Another important concept is narrative layering. Markets rarely operate on a single narrative. There are always multiple stories interacting at different levels. You may have a long-term macro narrative, such as a tightening cycle by central banks. Within that, you may have a medium-term narrative, such as growth slowing or accelerating. And within that, you may have short-term narratives driven by specific data releases or events. These layers can align or they can conflict. When they align, the market tends to move with clarity. For example, if long-term policy, medium-term growth, and short-term data all point in the same direction, price movement is often smooth and sustained. When they conflict, the market becomes more complex. You may see choppy price action, false breakouts, and increased volatility. This is because participants are interpreting the same environment through different lenses. As a trader, you need to identify which narrative layer is dominant at any given time. This determines how you should approach the market. If the dominant narrative is long-term, you may focus on positioning for larger trends and holding through volatility. If the dominant narrative is short-term, you may focus on tactical trades and quicker adjustments. Misalignment between your time frame and the dominant narrative is a common source of poor performance. You may be trying to trade a long-term theme in a market that is currently driven by short-term uncertainty, or vice versa. Understanding narrative layering helps you align your strategy with the prevailing conditions. There is also a structural asymmetry in how narratives influence upside and downside moves. Markets often move differently when narratives are strengthening compared to when they are breaking down. When a narrative is strengthening, moves tend to be gradual and persistent. Participation builds over time. Liquidity improves. Volatility is relatively contained. When a narrative breaks, moves tend to be faster and more violent. This is because the process is driven by position unwinding rather than new positioning. Participants who were aligned with the narrative are forced to exit, stop losses are triggered, liquidity can deteriorate. This creates a cascade effect. This asymmetry is critical for risk management. It means that downside risk in a crowded trade can be significantly larger than the upside potential. Professional traders account for this by adjusting position size, tightening risk parameters, or reducing exposure as a narrative becomes more mature. They are not just asking whether a trade is likely to work. They are asking what happens if it does not. This shift in thinking, from focusing on potential gains to focusing on potential losses, is a defining characteristic of professional risk management. You also need to understand the role of time in narrative development. Narratives do not just change in content, they change in relevance over time. A narrative that is highly relevant today may become less important as new information emerges. Markets constantly reprioritize what matters. For example, a central bank policy narrative may dominate for several months, but if economic conditions shift, the focus may move to growth or employment. The previous narrative does not disappear, but it becomes less influential. This creates a dynamic hierarchy of narratives. At any given time, certain themes will have more impact on price than others. Your job is to identify which narratives are currently driving the market and which are secondary. This allows you to focus your analysis on what matters most. One way to do this is by observing how the market reacts to different types of information. If certain data releases consistently move the markets, they are likely aligned with the dominant narrative. If other data is ignored, it is less relevant in the current context. This is a practical way to filter noise and prioritize your attention. Another layer of complexity comes from the fact that different market participants interpret narratives differently. Institutional traders, hedge funds, asset managers, and retail traders do not all process information in the same way. Institutions tend to focus on macro drivers, positioning, and risk management. Their interpretation of narratives is often more nuanced and grounded in data. Retail traders, on the other hand, are more likely to focus on simplified stories and short-term price movements. Their interpretation of narratives is often more reactive. This creates differences in behavior. Institutions may begin positioning before a narrative becomes widely accepted. Retail participants often enter later when the narrative is clear and widely discussed. This timing difference is important. It means that the point at which a narrative becomes obvious is often the point at which the majority of the move has already occurred. As a trader, you want to align more closely with the early phase of institutional positioning rather than the later phase of retail participation. This does not mean you need to predict narratives perfectly. It means you need to recognize when a narrative is still developing versus when it has already become consensus. Let's now consider how narratives interact with volatility. Volatility is not just a function of uncertainty, it is also a function of disagreement. When there is a clear and widely accepted narrative, volatility tends to be lower. Participants are aligned. There is less conflict in interpretation. When narratives are contested, volatility increases. Different participants have different views. Positioning becomes less stable. Price movements become more erratic. This relationship between narrative clarity and volatility has practical implications. It affects how you size positions, how you manage risk, and how you interpret price action. In low volatility environments driven by strong narratives, trends can persist. In high volatility environments driven by narrative uncertainty, mean reversion and short-term opportunities may be more prevalent. Understanding this allows you to adapt your strategy to the prevailing conditions rather than applying a fixed approach in all environments. Another important aspect is the concept of narrative inertia. Once a narrative becomes established, it tends to persist even in the face of contradictory information. This is because changing a widely held belief requires a significant shift in perception. Participants are often slow to update their views, especially if they are already positioned. This inertia can create opportunities. The market may continue to move in line with a narrative even as the underlying data begins to diverge. This creates a lag between reality and price. But this lag does not last indefinitely. When the divergence becomes too large, the adjustment can be rapid. This is why you often see markets ignore negative data during strong uptrends and ignore positive data during strong downtrends. The narrative filters how information is interpreted. As a trader, you need to recognize when narrative inertia is in effect and when it is beginning to break down. This again comes back to observing price behavior. Is the market still responding in line with the narrative, or are there signs of divergence? There is also a psychological dimension to narratives that you must be aware of. Narratives provide comfort, they reduce uncertainty, they give traders a sense of control. This is why traders are drawn to them. It feels easier to operate when you have a clear story that explains the market, but this comfort can be dangerous. It can lead to overconfidence. It can reduce critical thinking. It can cause you to underestimate risk. Professional traders deliberately avoid becoming too comfortable with any narrative. They maintain a level of skepticism. They constantly question their assumptions. This does not mean they are indecisive. It means they are aware of the limitations of their knowledge. This mindset allows them to remain adaptable, even in environments where the narrative appears clear and convincing. At this stage, you should begin to see that narratives are not something to be followed blindly. They are something to be analysed, deconstructed, and integrated into a broader framework. You should be asking questions such as, where is this narrative in its life cycle? How strong is it? How aligned are participants? How crowded is the positioning? How is price behaving relative to the narrative? These questions shift your focus from the story itself to the structure around it. This is where real insight lies. Over time, this approach allows you to develop an intuitive understanding of how narratives evolve. You begin to recognize patterns. You begin to anticipate transitions. But this intuition is built on structured thinking. It is not guesswork. It is the result of consistently analyzing markets through a disciplined framework. Bringing all of this together, the key is to treat narratives as dynamic, multi-layered, and inherently uncertain. They are not fixed truths. They are evolving interpretations of a complex system. Your role as a trader is not to predict narratives perfectly. It is to position yourself effectively within the environment those narratives create. This means aligning with them when they offer favorable risk-reward and stepping away when they become crowded or unstable. It means being willing to change your view as conditions change without hesitation or attachment. If you can develop this level of flexibility and awareness, you move beyond simply reacting to markets. You begin to understand them at a deeper level, and that is what allows you to operate with consistency even in an environment that is constantly changing. At this point, you need to start thinking about how to actively use narratives within your decision-making process, not as a standalone input, but as a structured layer within a broader framework. The mistake most traders make is either ignoring narratives completely or relying on them too heavily. Neither approach is effective. The correct approach is integration. Narrative should sit alongside macro data, positioning, and price action. Each of these elements provides a different perspective on the same system. When they align, your conviction increases. When they diverge, your caution should increase. So when you are evaluating a trade, you should be asking, what is the dominant narrative, and does price behavior support it? Is positioning aligned with it, or is it already stretched? Are macro fundamentals reinforcing it or beginning to diverge? This structured questioning allows you to assess whether a narrative is actionable. Not all narratives are. Some are interesting but irrelevant to current price movement. Others are highly influential and create clear directional bias. Your job is to differentiate between the two, and that requires discipline. You cannot treat every piece of information equally. You must prioritize based on relevance and impact. Over time, this process becomes more efficient. You develop a mental filter that allows you to quickly assess whether a narrative is worth acting on, but that efficiency is built through repetition and structured analysis, not intuition alone. Let's now focus on identifying narrative inflection points. These are the moments where a narrative begins to shift, either strengthening or weakening. Inflection points are where the greatest opportunities often exist because they represent a change in market perception. But they are also where uncertainty is highest because the new narrative is not yet fully established. To identify these points, you need to pay close attention to inconsistencies. Is the market reacting differently to similar data compared to before? Is price failing to continue in the direction that the narrative would suggest? Are there signs of exhaustion, such as slowing momentum or increasing volatility? These signals do not guarantee a shift, but they indicate that the current narrative may be under pressure. At the same time, you must avoid acting prematurely. Not every inconsistency leads to a reversal. Markets can remain aligned with a narrative longer than expected. This is where patience becomes critical. You are not trying to predict the exact turning point. You are waiting for sufficient evidence that a shift is occurring and then positioning accordingly with controlled risk. Another key element is understanding how narratives influence different asset classes. Narratives rarely exist in isolation within a single market. They tend to propagate across asset classes. For example, a narrative around rising interest rates will impact currencies, equities, bonds, and commodities, but not in the same way. Each asset class will respond differently based on its own dynamics and sensitivities. This cross-asset behavior provides valuable information. If a narrative is truly dominant, you should see consistent reactions across related markets. If you do not, it may indicate that the narrative is weaker than it appears. For instance, if a growth positive narrative is driving equities higher, but bond yields are not rising, there may be a disconnect. That disconnect can signal uncertainty or conflicting interpretations. Professional traders use these cross-asset relationships to validate or challenge narratives. They do not rely on a single market in isolation. This broader perspective allows you to identify opportunities that may not be visible when focusing on one instrument alone. Let's now address the role of timing in narrative-driven trading. Even if you correctly identify a narrative, timing your entry and exit remains critical. Entering too early can result in drawdowns if the narrative takes time to gain traction. Entering too late can result in poor risk-reward if the move is already advanced. This is why narrative analysis must be combined with execution discipline. You need to identify not just what to trade, but when to trade it. Price action plays a key role here. It provides confirmation of whether the narrative is being acted upon by the market. Breakouts, trend continuation patterns, and changes in volatility can all provide signals. At the same time, you must manage expectations. Not every trade will align perfectly with the narrative from the outset. There will be noise. There will be false signals. Your objective is not perfect timing. It is consistent positioning with favorable risk-reward over a series of trades. Another important consideration is the difference between explicit and implicit narratives. Explicit narratives are those that are clearly articulated in media and analysis. Implicit narratives are those that are reflected in price behavior but not yet widely discussed. Implicit narratives are often more valuable because they represent early-stage shifts in perception. They are not yet consensus. They are not yet crowded. Identifying implicit narratives requires careful observation. You need to look at how the market is behaving, not just what is being said. Is price trending despite a lack of clear explanation? Are certain assets outperforming or underperforming without obvious justification? Are there subtle shifts in correlation patterns? These are the types of signals that can indicate an emerging narrative. As a trader, developing the ability to recognize implicit narratives gives you a significant edge. It allows you to position earlier before the broader market catches on. There is also a risk of overcomplicating narrative analysis. Because narratives are inherently qualitative, it is easy to get lost in interpretation. To avoid this, you need to maintain structure. You should define clear criteria for evaluating narratives. For example, you may assess strength based on consistency of price movement, alignment with macro data, and level of market participation. By applying consistent criteria, you reduce subjectivity. You make your decision-making more repeatable. This is critical, because without structure, narrative analysis can become arbitrary. You may end up justifying trades based on stories rather than evidence. Professional traders avoid this by anchoring their analysis in observable behavior. They use narratives to provide context, but they rely on data and price to validate their decisions. Another layer to consider is how narratives interact with liquidity. Liquidity conditions can amplify or dampen the impact of narratives. In high liquidity environments, markets can absorb flows more easily. Narrative-driven moves tend to be smoother. Trends can develop gradually. In low liquidity environments, even small shifts in narrative can lead to large price movements. This is because there are fewer participants to absorb the flow. This is particularly relevant during periods such as holidays or when major participants are absent. In these environments, narratives can appear more powerful than they actually are. As a trader, you need to adjust your expectations based on liquidity conditions. A move that occurs in low liquidity may not be as reliable as one that occurs in high liquidity. This again highlights the importance of context. Narrative alone is not enough. You must consider the environment in which it is operating. You should also be aware of how narratives evolve differently across time frames. A narrative that drives intraday movement may be irrelevant on a weekly time frame, and vice versa. This creates opportunities for different types of traders. Short-term traders may focus on tactical narratives driven by news or data releases. Longer-term traders may focus on structural narratives driven by macro trends. The key is alignment. Your trading style should match the time frame of the narrative you are targeting. If you are trading short-term but basing your decisions on long-term narratives, you may experience frustration because the short-term price action may not reflect the longer-term view. Conversely, if you are trading long-term but reacting to short-term narratives, you may exit positions prematurely. Understanding this distinction allows you to operate with greater consistency. At a higher level, narrative analysis is about understanding how information is processed by the market. It is about recognizing that markets are not purely rational, but they are also not random. They operate within a framework of incentives, perceptions, and constraints. Narratives are the mechanism through which these elements are interpreted and acted upon. By analyzing narratives, you gain insight into how participants are thinking, and by understanding how they are thinking, you can anticipate how they are likely to act. This is not about predicting every move. It is about positioning yourself in a way that aligns with the most probable outcomes while managing risk effectively. Over time, this approach leads to more consistent decision-making because you are operating within a structured framework rather than reacting to isolated events. To conclude, narrative is one of the most powerful yet misunderstood elements of market behavior. It shapes perception, it drives positioning, it influences price, but it is not static and it is not always accurate. Your role is to engage with it critically, to understand its life cycle, its strength and its limitations, to integrate it with data, positioning, and price action. Most importantly, to remain flexible, to avoid attachment, to adapt as conditions change. If you can do this, you move beyond simply following the market. You begin to understand the underlying dynamics that drive it, And that understanding is what allows you to operate with confidence, discipline, and consistency over the long term.